Hello and welcome to our weekly look ahead at markets here. It's been seen an interesting week over the last few days in the markets, particularly in rates markets, and that's what's been driving the price action in the moment in FX and in stocks, as well as oil and some of the other asset classes that we look at. The key thing has been the inflation story. So US inflation was stronger than expected. The CPI came in at 0.5% versus the 0.4% expected. The PPI on Thursday, that really scattered the doves, if you like, and that came in at 0.7% versus 0.4% expected. So US inflation proving stickier, more persistent than market maybe thought, and what that's seen is a big repricing in the rates market, in the Fed fund futures market. We've seen the US 2-year Treasury yield jump about 60 basis points over the last couple of weeks. We've seen the US 10-year Treasury yield jump about 50 basis points over that time frame. And the US 10-year yield actually on Friday above 3.9% is its highest since November. So the market is repricing for the Fed to stay higher for longer, as we've been saying consistently. Anyone who's been reading the morning notes that I send out will know that that's been the thesis for a long time now, and that is what we're seeing. The market coming back round to it. We had that pivot narrative last year. The pivot never happened. Now we're getting the pivot narrative again, but the Fed is not going to be able to pivot because it's become data dependent, and now the data is not going to allow it to pivot because it's going to stay higher. The inflation is going to stay higher for longer. So what we've seen is quite a significant repricing of the market. Fed funds futures for December now showing 5.1% versus 4.35% not so very long ago. So the market has moved from pricing in one hike in 2023 plus a couple of cuts to pricing in as much as maybe 4 hikes this year. And I think it's not out of the realms of possibility that we hit 6% on Fed funds rate. So the market's coming around to this idea. I think there's more tightening to be priced into the market. That could be good for the dollar. We've seen some strong bid for the dollar coming through. I think the market needs to reprice a bit more tightening coming in. We are getting to the point though where I think the market is coming around to where it needs to get to in terms of the Fed, in terms of the terminal rate. I think somewhere around 5.5% to 6%. The market's going to drift up towards that level, but there is some way to go. The question mark remains over the duration. How long does the Fed stay at that sort of level? I think duration is key here. I think duration could be longer than the market thinks at the moment as well. So that's the story coming into this week ahead. Now, on Monday is Washington's birthday, so that's a holiday in the US for the New York Stock Exchange and others. Looking further down the line though, it's the PCE inflation numbers out at the end of the week that's going to be the key thing. That's the Fed's preferred gauge of inflation. We all know that. The core PCE index, that's the one that excludes volatile elements like food and energy. Of course, consumers still notice food and energy prices more than just about anything else. So, but the core reading is important because that's what the Fed is really looking at. That came down, I think, from 4.7 to 4.4% previously. So that's been trending. That's shown the disinflationary trend. But if the PPI and the CPI numbers are anything to go by, then maybe they won't come down as much as the market is hoping for. We've also got some earnings due out from the likes of Coinbase. We've got the retailers kicking off in the US, Walmart and the Home Depot. And we'll continue to keep an eye on some of these interesting earnings reports as they come through. Otherwise, there's some mixed bag of data. We've got some PMI releases and the usual weekly oil inventories, gas inventories, and weekly US unemployment claims data, which has been another factor in why the market's repriced on the December funds futures. That is because the US labour market remains strong, it's holding up well, and with that combined with higher inflation, leaves the Fed with little else to do but continue hiking rates. That's it for now. Thanks for watching.